This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, I'm going to go through chapter 8 of the free lecture notes, which is headed Relevant Cash Flows for Discounted Cash Flow. And I did say in the previous chapter, in the lectures on the previous chapter, that any questions on investment appraisal in the exam, and there will be, by far the majority of them will be on discounted cash flow. And the problem of discounted cash flow questions shouldn't be the actual discounting. You know, we went through all of that. You're given tables in the exam. That has to be fast and doesn't carry many marks. But the real problem, especially in the long form questions, the real problem is reading the question carefully and actually calculating what the cash flows are that ultimately we do the discounting on. And so that's what we're looking at here. There are several things we need to consider in this chapter. But the first is what you might call the overriding principle that we're after, which is on the first page. You'll see the general rule is that we're looking for all future incremental cash flows to the company. As far as cash flows are concerned, as stressed in the previous chapter and explained why, it's the cash receipts and payments that we're concerned with, the cash inflows, outflows. And so any mention of things like depreciation is there to try and trick you. Depreciation may appear obviously in your statements of profit or loss, but depreciation isn't a cash flow. It's the cash inflows, outflows that we're concerned with. It's the incremental cash flows. Incremental means extra. And so what we're after, if we're considering a new machine, is what extra cash flows will there be to the company. So it's not that just the flows directly related to our new machine. You know, maybe our new machine is going to generate income of 10,000 a year. But maybe buying the new machine will also affect other products in the company and give an extra 2,000 there. Well, fine, it's all extra cash flow effects on the company of doing this new project or buying this new machine. It's all future cash flows. What I mean there is maybe we're thinking of buying a new machine which will cost us 100,000. We've done market research to estimate what the returns will be from the machine. We think it's going to generate 20,000 a year. We've had this market research done though, and the market research cost us 20,000. Well, if we've already paid that 20,000, if we've already done the market research, it's irrelevant to the decision. We've paid that 20,000, whatever happens, whether we buy the machine or we don't buy the machine. What we're concerned about is it worth spending an extra 100,000 to buy the machine for whatever extra returns it'll give us in the future. So always we're looking at future cash flow effects, extra cash flows that will occur to the company as a whole. And again, as I've written there, we're not interested in the following: money already committed. That's like this market research. If we've already spent or know we're going to have to spend 50,000 on market research, whatever happens, it's irrelevant. It's a sunk cost. We're not interested in historic costs. What I mean by that is whatever values are in our statements of financial position for non-current assets are irrelevant. We're not interested in balance sheet values, statement of financial position values. You know, it's what's the cost of the machine, how much cash will we get when we sell the machine, and so on. I've already said we are interested in non-cash flows. The most likely one you might see is depreciation. It's there well, not to trick you, but to test you, any non-cash flows are completely irrelevant. Book values, well, again, the book values, the balance sheet, step to financial position values, irrelevant. Interest cost, now this is something I'll come back to, but very often you're told, oh, we'll buy this new machine because we're borrowing money, there'll be interest payable on the borrowings of £1,000 a year. Well, although that's a cash flow, if we're paying interest, we ignore it because if you think back to the previous chapter, the whole reason for discounting is to account for the interest. If we discount at 10%, that's effectively, again, accounting for interest at 10%. We don't want to bring that in as a cash payment as well. It'd be counting for it twice. We're interested in both direct and opportunity cash costs and revenues. And what we mean by opportunity costs, I think you should be aware from paper F5, but it could be, you see, that this new project gives us an inflow of £10,000 a year, a cash inflow, fine, that's relevant. But maybe buying this new machine to make this new product will lose us some revenue we're already getting from another product. You know, we're already making one type of desk and earning money. This machine will make a new type of desk. It'll earn us £10,000 a year. But sales of the other desk will fall a bit. And the company will lose a bit of revenue or profit. So maybe there's lost earnings from another product of £2,000 a year. Well, we are receiving £10,000, a cash flow. We're losing £2,000 of existing earnings. And also, although that's not actually a payment of cash, if the business is losing cash elsewhere, then effectively it's a cost of doing this new project. We'd say the net benefit, we get £2,000 from this machine, but as a result we'll lose £2,000 somewhere else. The benefit is a net £10,000 a year, £8,000 a year. And that £2,000, as I say, it's not because we're spending £2,000, it's because we're losing £2,000 that we're already earning. It's an opportunity cost. An opportunity cost is where you're losing money that you're currently getting. Anyway, those are the principles. Let's look at an example. And this first example is purely looking at the sort of individual tricks that can bring in a question in relation to this future incremental cash flows. We're not going to do any discounting on this one. We'll turn it into exam type questions later. But have a look at example 1. A research project which has to date cost the company £150,000 is currently under review. And if you look at the bottom, it says we're going to advise the director as to whether the project should be allowed to proceed. So we've got this project, we've already spent £150,000, and we're wondering whether to simply stop the project now or continue. And if you look back to the top of the question, if the project was allowed to proceed, if we do continue, we'll complete it in about a year and we'll be able to sell the results to a government agency for £300,000. And shown below are the additional expenses which the managing director estimates will be necessary. And so our decision, it's going to be based on cash flows. It's basically, if we proceed, we will get £300,000 from the government, but with a load of costs there we need to look down. Well, if the costs are more than £300,000, it's not worth proceeding, we'll stop. If the costs are less than the income of 300,000, then we will continue. So we know what the income is going to be, 300. Let's look at all the costs involved and decide which of them and how much of them are relevant. First of all, it says the research project has cost the company so far 150,000. Well, these are sunk costs. We've already spent the 150,000 and we're not going to get it back. So whether we stop the project now or whether we continue makes no difference in terms of the 150,000. That's gone. So those costs are not relevant. I'm going to list all the costs and then we'll add up. Further down, shown below are the additional expenses which we estimate to be necessary. First of all, materials. The materials required have just been purchased at a cost of 60,000. So we've already bought the materials. Those materials are there whether we continue with this project or we don't. Again, the 60,000 is a sunk cost and not relevant. What is relevant is what happens if we stop the project. What I mean is, you see, if we carry on with the project, we'll simply use those materials. There's nothing else to spend, it's already been spent. Now, what's going to happen if we don't do the project? Well, it says in the note, these materials are toxic, poisonous, and if not used in this project, we're going to have to dispose of them and it'll cost us 5,000 to get rid of them. Now think about it. I've already said the cost of buying the materials is gone. Carry on or don't carry on, we've spent 60,000. It's irrelevant. Continue with the project and we use the materials, there's no extra cost, but stop the project. And what would happen? We'll have to spend 5,000 in order to get rid of them. So it's a very odd one, this. If I carry on doing the project, we won't need to dispose of the materials and we'll save that 5,000. It's a saving, or it's like a negative cost. I'm going to list the costs here. And so a saving is a negative cost. It's actually going to save us 5,000 if we carry on and do the project. For the last time, do the project, no extra cash flows at all. We've got the materials. But don't do the project, we would have to spend 5,000. Do the project, we don't have to spend that 5, we save it. Look at labour. Next one. Skilled labour is hard to recruit. The workers concerned have been transferred to this project from a production department, and the production manager claims that if the men were returned to him, they could generate sales of 150,000 in the next year. I will read the rest of it in a minute. If we stop the project, these men will go back to another department and they'll get us revenue of 150,000. And so here we have an opportunity cost, haven't we? That if we don't do the project, these men could be getting us revenue of 150,000. If we do the project, then we won't get that revenue. Doing the project will lose us a revenue of 150,000. It's a cost of doing the project. Again, don't do it and we'll earn 150. Do it and we'll lose the 150 we could have earned. As I say, an opportunity cost. However, there's more involved. The prime cost of these sales would be 100,000, including 40,000 for the labour. Now, I doubt he'll use the word prime cost in F9, but you should be aware, from paper F2 in fact, that the prime cost is labour plus materials. Now, it says the prime cost of those sales, we've already said, if we do the project, we're not able to earn the 150,000 that we could have earned elsewhere, the revenue. But those sales would be costing 100,000. 40,000 of it is for labour. And so 60,000 would be for materials. Now, why is that relevant? Because if we don't do the project, these men will be transferred back and be earning revenue. But of course, if they're earning revenue by making another product, then we'll have the costs of the other product, which we won't have if we do this project, because we won't be making the other product. And so what's going to happen? Although we'll lose revenue that we could have earned of 150, we'll save on the materials 40,000. Again, it's a saving, so a negative cost. Because if we don't make this other product, which we could have done, okay, we don't get the revenue from the other product, but because we're not making it, we don't have the cost of the other product either. We don't have those materials. The materials, sorry, was 60, not 40, 60. Now, I say we don't have the cost of the other products. We certainly don't buy the materials if we're not making this other product. What about labour? We won't save anything there because these workers will be being paid, will pay the labour, whatever happens. If they work on this project, this new project, we'll pay them 40,000. If we stop the project and instead they make the other product, we'll pay them 40,000. So there's no extra costs or savings involved there. We're paying the labour anyway. And finally, this other product, the overheads absorbed into the production would be 20,000. Well, watch for this. Overheads are only relevant if the total overheads for the company change. If the overheads of the company overall increase as an extra cost, if they reduce as a saving. However, simply absorbing overheads, absorbing means charging, that doesn't suggest the total overheads of the company will change. If you're making several different products, you can charge or spread the overhead between them for profit purposes any way you want. But simply charging part of the overheads to a product doesn't mean the total overheads change. And so if ever you see overheads have been absorbed, it's of no relevance. Overheads are only relevant if it's clear that they actually change. If the increase is an extra cost, if the total reduces, there's a saving. So that's finished the labour section. What about research staff? It has already been decided that when work on this project stops, the research department will be closed. But remember, our question is, are we going to close it now, or are we going to continue for a year and then we'll close it? Research wages for the year are 60,000, and redundancy and severance pay has been estimated at 15,000 now, or, if we wait a year, 35,000 in a year. Well, I'm trying to work out here the costs of carrying on for a year, because remember, either we carry on for another year or we stop now. Well, of course, if we do carry on for a year, we will have to pay a year's wages, 60,000. So there's another extra cost of continuing for the year. What about redundancy and severance pay? You know, when you close, you have to give them a payment. Well, if we stop now, we would pay them 15,000. On the other hand, if we do continue for a year, we're going to have to pay 35,000. So, you know, don't continue, we pay 15. Do continue, we pay 35. Well, the extra cost of continuing is the extra severance and redundancy pay. 15 now, 35 in a year. Continuing will cost us an extra 20,000. Remember, we want the extra cash flows to the company. Equipment. The project utilises a special microscope which cost us 18,000 3 years ago. Well, that money's already been spent, it's irrelevant, it's a sunk cost. Whatever happens, 18,000 is gone, whether I continue or I don't. It has a residual value of 3,000 in another 2 years. Well, irrelevant, we're not going to continue 2 years. Remember, we either stop the project now or we continue for 1 year. It's got a current disposal value of 8,000. So if we were to stop the project now, we could receive 8,000 by selling it. However, if we used in the project, it's estimated that the disposal value in a year's time will be 6,000. And so what's the relevant cost here? If we stop now, we'll receive 8,000. If we continue for a year, we'll only get 6,000. And so continuing, surely, is going to lose us 2,000. The cost of continuing is the lost disposal value. 2,000, that's the cost. We lose 8,000 now that we could have had. We will get 6,000 in a year. The net cost of continuing, 2,000. It's another opportunity cost. We're obviously not spending any money, but it's lost cash as a result of doing the project. Finally, general building services. The project is charged with 35,000 per year to cover its share of general building expenses. Not relevant. Similar reasons to the overheads mentioned in the labour section. They're charged with a share of general building expenses. The total building expenses for this company, though this company is doing lots of things, the total building expenses, I don't know, they may be 200,000. And for profit purposes, you can split that any way we want between the various products or projects. There's no mention here of the total cost changing. We're only concerned if the total cost to the company changes. And again, simply charging it between various projects doesn't mean that the total is changing. So the fact it's charged through 35 or we're absorbing 35, not relevant. Immediately the project is discontinued, that the space occupied by the project could be sublet for a rent of £7,000. What does that mean? If we stop the project now, we can rent out the space for £7,000. We can be earning £7,000. If we continue for a year, then obviously we can't rent it out for this year. We won't get the £7,000. So continuing for a year, there's another opportunity cost. The lost rent that we could have earned. The project, remember, lasts for a year. If we don't do the project, we could have received £7,000 rent. Doing the project, we won't receive it. We lose £7,000 we could have had. An opportunity cost. It's therefore a cost of doing the project. So we've been through all the costs. Let's now add them up. There was a saving of 5, so a negative cost, plus 150,000, minus 60,000. Oh, plus 60,000, plus 20,000, plus 2,000, plus 7,000. I get a total of 174,000. And remember, even though we're not doing any discounting in this example, as stressed enough in the previous chapter, whether we accept, whether we, in this case, go ahead for a year or we don't, depends on whether there's a net cash surplus or a cash deficit. Well, here the cost is 174. Back to the second sentence. The revenue, if we continue, would be 300. Well, I said at the beginning, if the costs are more than 300, it's not worth continuing. If they're less than 300, it is worth continuing. Here, we will continue. We will effectively do the project for another year. Now, I don't know if you've done at paper F5, you'll recognise that sort of thing. It's very similar to something we did in F5. In paper F9, you won't get a question like that. You know, here we didn't do any discounting, and in all the later examples, we're going to start discounting and look over, 1 year, 2 year, 3 year, and so on. However, I wanted to do example 1, because although there won't be a whole question styled like that, each bit of that question could be relevant, has been relevant in the past. The way we think about the costs, always, for each of them, we were saying, what is the future incremental or extra cash cost to the company? So as I say, to get it all, it just wouldn't happen. But any bit of that could be asked anywhere in the exam. It's important to see the logic. Anyway, having said that, the rest of the chapter and the rest of the lectures on this chapter, we're going to start making them more like exam questions. And there are 3 specific, what you might call rules, I don't like using the word rules, that we need to sort out. How to deal with what we call working capital, how to deal with tax, and how to deal with inflation.